got a pretty good day going today. Um, well, if you're long, then it may not be too good for you. But if you're short like me, then you're having an outstanding day. I've been short Tesla, and I still have some open positions on. Well, a open position on in Tesla. Right now, so I'm rocking a $500 day so far. Um, in Tesla. So basically, what I want to talk about today is I want to go over just the basics, like calls and puts, and then I'll just kind of go from there. So today we'll just talk about buying a call, buying a put, and what does it look like? And we'll talk about, some of the advantages and disadvantages of doing so, right? So let's first thing we're gonna do, let's give a little market overview. Right now, we got currently, if you're looking at my watch list over here to the left, we got the VIX is up 8%. That's a big jump. So we are up around 3267 on the VIX. That's an 8% jump. We got the S&P futures down over 2.5%. We got the NASDAQ futures down almost 3.25. Got the Dow futures down 2%, and the Russell futures are down 3%. The bonds are down about ZB 0.5%, almost the same for the notes. Oil is down about 0.75%. And gold is down slightly flat, you might as well say. We got Bitcoin down 1%, hanging out around 19,000. Financials are down. I'm looking at the XLF. It's down 1.5%. Energy is down. And then if we come down here and we look at the advanced decline line, we got 461 out of 500 stocks negative out of the S&P 500. If you look at the FANG, we got Meta, formerly Facebook, down almost 4%. Apple is down. When Apple's down, pretty much because Apple is a large player in the indices, so that's going to take everything down for the most part. One of our I think it is the largest stock, if I'm not mistaken. Amazon is down, Google is down, Microsoft is down, and Tesla is down 7%. Got Netflix down. All the stocks that matter are down. So it's imperative to be able to understand how to do neutral strategies, short strategies, and long strategies when trading the stock market. So today I just happen to have, some short strategies on, right? And so looking at right now, I got Tesla up. This is a 4 hour chart of Tesla. So what that means is each candlestick is 4 hours, a 4 hour increment of time. And I have like extended session. So meaning like I got it the overnight session showing as well. I don't have it checked where it wouldn't show that. You can come and check it and change that information. Like I could come up here to the settings, click on that little gear. Okay, I'm gonna click on this gear again, and then I could come to sessions. And if you see where it says extended hours, if I was to click on this, right, and take that off, it would take out the overnight session and I would just see the actual New York session, basically from what 9:30 to 4 o'clock. But I wanted to see the overnight session as well to do my technical analysis. I don't always do that, but sometimes I do. Now, what are we talking about today? Now, I just happened to buy some puts today. We're going to talk about calls and puts. I want to read you the book definition. You can Google it and look it up on Investopedia. I'm just reading it, so just so you have that book definition. Then I'm going to give you the skinny on it, like easy to understand, right? So, a call option, basically, when you're buying a call option, we're just talking about buying today. I'll do another video and talk about selling them at another time. We'll do buying to keep the video short, and then I run through them, in consecutive videos. A call option is an option contract giving the owner the right but not the obligation to buy a specified amount of an underlying security at a specified price within a specified time. All right. I wanted to give the book definition, and now I just give you my definition. When you buy a call option, it gives you the right to purchase the stock at that price if you want to, or you can just take a bet or whatever you want to call it on the stock going up. Because if I buy a call option, I have the assumption that the stock or the commodity or the bond, the derivative, that whatever it is that I'm trading, that underlying, I think is going up. And I'm generally going to buy the strike price, like in the middle. This is an option chain. First of all, I'm on TastyWorks platform. This is the option chain. You pick whatever contract or whatever set or time period that you want to trade in. So if I wanted to, this says 1 day. So that means this option contract will expire at the end of the business day tomorrow. It has 1 day left on it. So right now, Tesla is trading at $266. You look up here and you can see where it says last. This is in the bid ask. Bid ask spread is just the price of the actual market. Buyers, sellers, and you meet in the middle on the price, right? So if I wanted to buy a call option, I could come over here and pick any one of these at any one of these strike prices, right? You got 265, 267, 5, 266, 67. Matter of fact, I'm not going to use Tesla because it got these 0.67s and 0.5s. I'm going to make it easy. Let's go somewhere. Let's look at Apple. And it's a reason why I want clean whole numbers. And that's why I'm using Apple. That's the only reason why I switched. Now you see 141, 142, 143. So I got out all the decimals just to make it easy for this particular example. Now, if I buy this call option right here, let's say at 140, right? I got 1 day on this call option. I'm buying it because I think that the market is going to go up. If the market goes up a buck, just look at it. I'm gonna click it. Right? I mean, you just click on the ask. I got ask. That means I want to buy. You can see it's green. I'm gonna take this off and delete it. If I clicked on the bid, that would mean that I would be selling it. That we're not dealing with selling today. So we will go to the ask. Left click right here in the ask column. That's showing that I want to buy this call. Hit this lock down here so the price doesn't fluctuate. I'm going to pay $235 for this call option. Now, I am in essence controlling 100 shares of stock for the most part. And the reason why I say for the most part is because we got something over here called delta. And that delta is a 61. So basically, for each dollar movement of the stock price, I'm going to gain 61 cents. Now, I'm going to show it to you on here. If you see it's moving because the stock price is moving. See how I got 235 and you see it's moving? If I unlock it, it's trading for 244, right? If I go up the chain, now it would be what, 315, 320 from what, 250? That's what, about 65, 60, $70. That's your move and your delta. And then now you'll be operating at this delta. So, but to make it easy, you're buying this call option thinking that the stock will go up. And as the stock goes up, the price of the option that you purchase will go up which means you'll be able to sell it back out at a higher price. If it goes up, if it goes down, you see it, you will lose value. It's like it's like buying a car on an accelerated like depreciation, like a super acceleration. Like your car wouldn't depreciate that fast because you're buying something that has an expiration date on it for tomorrow, right? So that means that the value of it is almost like if you go in the grocery store and you look at a carton of milk. Sometimes and you see these sales on like milk or on like sometimes it could be like romaine lettuce. So you go in there and they got like a manager's special. I be seeing that a lot, and then you be like, oh man, it's only 99 cents for this organic lettuce. You'd be like, why is it so cheap? And then you look at the expiration date and it expires today or tomorrow, and so they got like what you might see manager special on it because they're trying to hurry up and get rid of that lettuce. So they give you a cheaper price. So the cheaper, so the closer we get to expiration, the more value comes out of these options. So when you buy it, you're on the clock. So you need to be right. So the reason why I'm talking about this is because as opposed to like day trading, now if I bought 100 shares of Apple thinking it's gonna go up. Now I own 100 shares. That's gonna be what? That's $14,000. That's $14,000 to buy 100 shares of $140 stock. So the so the whole, let me make sure I know my math right, but I just want to make sure because I am online. Yeah, you just buying 100 shares. Yeah, $14,000. So for you want to buy 100 shares, get $14,000. Margin requirement. Well, margin, they probably margin you like half of that, 7 grand on a margin account. But still, when I can buy this call and only be out of right now, what, 252 bucks. If you buy 100 shares of Apple at 14 grand and it goes up $1, you make what, 100 bucks on 14 grand worth of risk. I buy this call, pay. Now earlier, just since I've been on here, what, it was 235 when I first clicked on it. Now it's at 262. So I could have sold back out of it and what, made 27 bucks. The risk, it's another way of using your buying power, using your money more efficiently to do the things that you want to do. And opposite thing, I would be doing it with puts. Now, the thing that then buying a put just mean that I'm thinking the market gonna go down. So instead of coming over here on the call side, I can click this and drag it over and buy the put, right? And the only thing about options is once they expire, right? So if you buy this call, right, at 140 and the market expires, let's say the market, let's say tomorrow, and you hold this to tomorrow at expiration, and Apple is trading at 139, this call option to be worthless. It's going to be worthless. Apple could expire, excuse me, could be at 139.99 and close on Friday, and you got this 140, it's gonna be worthless. It's only worth something if it's at your strike price or higher. And then what'll happen then at that point, if it's at 140, I believe it had to be at 140 or 141. Well, excuse me, 140.01 or something like that. And 140. So once it expires at the end of the business day tomorrow and it's at 140 or higher, you would own 100 shares. You're gonna take ownership of those 100 shares. So that's why I wouldn't hold it, like, unless you got. Now, if you don't have the 14 grand in the account, the brokerage will probably liquidate the position, and it'll result in a cash, it'll go back to cash or whatever it's supposed to be. But they'll liquidate this position if you don't have the funds, right? And so, well, what'll happen is what you paid for it, it'll be minus that. That would be subtracted minus the 100 shares because you paid two. So you paid right now. If you buy, you'd be paying 280 for it, right? So that price would come. That's the premium that you're paying for to own it at 140. So you don't want to hold these to expiration. So like if it went, let's say Apple closed on Friday at 146. So you paid two, let's just call it because it's moving around. Let's call it $200. So you paid $2 for it, which is $200. It's gonna close at 146. That's $6 profit, which is basically like $600 minus the $2 you paid. You'd have a $4 profit. Now, if it expired like right there at 140 and you paid $200 for it, minus the $2, you'd be down $200. You would have lost that premium that you paid for it. So that's one of the things about owning, like buying options. You need to be right and you have to be able to manage your time. Now you could say somebody might say, well, just don't do one day. Buy further date options. Buy them out further in time. Excuse me. You can do that. When you buy them further out in time, you pay more. So just keep your eye on this. What's that? 140, 275, let's just call it. Let's go out 50 days and buy it at 140. There you go. 1 grand. See, 10, that's $1,000. That's how much you paying for it to own it for 50 days. Now it gives you more time to be right, but you're paying for that premium. You're paying that for the to you're basically buying more time. You're literally buying time. You want to pay for more time to own it and give it more of an opportunity to go up. That's what you'll pay for it. And the further you go on time, the more expensive it's going to become at that strike. Now you can come out here and like buy at 155 and then pay $350 for it at 155. But now you need the stock to make money. You need the stock to go up still to 155. Because you're saying that in 50 days, you're going to get a $15 move, or you at least think it's going to go up, 5 or $10. So if it goes up $5, you can see you might make 160 bucks. And all I'm doing is going up on the option chain to see how much it would be worth if it went up $5, $10. And then if it went all the way up to where it was right here, where the stock would be trading like what we call in the money. Yeah, that's where it's trading at for $1,000, 50 days from now. Same thing. I'm just utilizing the call side, but you do the same thing on the put side that you as you do on the call side. It's just that when you buy a put, you think the market's going down. When you buy a call, you think the market's going up. I never hold options to expiration. Never. I've never been put shares. Never, because I never hold them to expiration. When you're buying, in my opinion, the way I trade, none of that stuff ever comes into play because I don't hold stocks. I have a certain way that I trade to where I never have to deal with that assignment or any of those things. I'm out of the trade once I know I'm wrong. So I'm not holding it, praying. Cut my losses and move on to something else. So that's why I don't really deal with assignment. I'm just talking about it just so you would understand what will happen. Now today, currently, I was in and out of Tesla. I bought a I bought a put today at 265 at this strike right here. But when I bought it, I think I paid like $200 for it or something like that. Sold out of it. Made like a little $40-$50 scalp. And then I had another put that I bought early when the market opened. And that one I sold, that's the one that I made like $340 on or something like that. Right. And I could have made more than that. I owned this strike right here, the 280. And you see right now it's selling for like 12. I sold out of it like up in here somewhere around 7 or 800 bucks, something like that. So, but I didn't, I paid 5 or 6 for it. So if you're right, you don't have to buy all of those shares and be out of that much money. Because to buy 100 shares in Tesla is $268 stock. So in my opinion, if you're just day trading, why not come over here and buy? So someone would ask, how do you know which one? I'll say this, you don't know which one to buy. But how I determine which one that I want to buy is like this. Depending on how close I am to expiration, depends on which delta I use to buy. I may have to do another video for that, but I will explain the movement or what you want to keep in mind when you're picking what option to buy. I always have delta up here because delta is going to show you how much you'll make per strike price movement, right? So if you buy something that has like let's say a 60 delta, if I were to buy this one right here, for every basically these strike prices, they have some weird option strike prices. I don't know why they have 0.67 and zero point 0.5 and 0.33. It's kind of crazy, but it's liquidity at all of them too. So I'm gonna go back to Apple again because this is just a weird one to try to show you on. Apple got clean strikes. Yeah, all $1. For each, if I buy this one and I want the market to go down because I'm on the put side, I'm on the right side. If you look over here, um, these are calls right up here, calls and puts. If I buy this put and I buy the 57 delta, if it goes down a buck, I should make 57 bucks. Look, two what? 257, 256. You see? You're controlling 57. It's almost like owning, like shorting 57 shares, if you think about it that way. So you got a dollar movement in the stock and you made 57 bucks. If you got a $2 movement in the stock, now this delta, once it moves down $1, it now has a 66 delta. So as it moves further down and moves further with your put or further in the money, your deltas will increase, which means you're gonna get, and they continue to increase until like right to where you're almost at dollar for dollar, like owning 100 shares. What you would call a synthetic stock position. When you buy deep in the money calls or deep in the money puts, you're basically getting a synthetic short without shorting or buying 100 shares of the stock. So I could delete this one and buy this one right here. This one right here, 147. This is basically synthetic stock because I'm gonna make 92 cents for every dollar movement, and then and once it moves $3 more, I'm right at 99 cents. And right here, I'm right at $1. So I'm dollar for dollar tick at this point. For every buck that it moves, I'm making $100, just like I owned 100 shares, but I'm only paying $1,100 for it. So depending on your conviction, you may say, man, you may have a setup on your chart and say, all right, I really believe that Apple is really going to go down. Whatever whatever setup you have, whatever you think. And instead of me just buying this one for $2, nah, I'm gonna go ahead and pay $1,100 for it and get dollar for dollar exposure on Apple. And that's buying calls and puts. One thing you have to keep when you buying these stocks, you don't have to worry about early assignment or anything like that. You just don't want to hold this to expiration, and then you have to worry about taking ownership of the stock, especially if you're in the money. And if you're in the money, like if the stock has gone past your strike price, whether it be you got a call and it's further past your strike price, or you got a put and it's way below it, you're basically gonna own the stock, but you're gonna own the stock at the price that you bought the contract at. So you'd own it. That means you get this price at 141 and it traded lower to 133. So that's $800 you made on that short. Now they're gonna take out what you paid the premium. So you paid, $2 for it. It went down 8 minus 2. It's gonna leave you with 6. Leave you with $600 profit. So, but like I said, I don't really deal with the best thing to do is not to hold them to expiration. Don't even deal with that. And if you really just, I would if it was me and I really felt like I just want to own the stock, I just buy the stock. Just me personally. So that way you don't have to deal with, you don't have enough money in your account, take ownership. Then, you getting liquidated. You having to deal with the brokers, with your brokerage and them having to do stuff for you. Lost my screen. All right, here we go. So for me, one of the things that I do so that I never to alleviate all that is to be if I'm trading like I was trading this one day, it's a scalp. I'm in, I'm out. I'm in and I'm out. And now tomorrow I may trade it. This to say 0 days. Then if I trade this tomorrow, it'll be in and out for me. In and out. I ain't holding it. I like to get my little coins and then be out. We'll talk about this position that I currently have in Tesla. Still got a position open in Tesla. Got 22 days on it. This is a um, short call spread, right? So I sold the 305 strike and then purchased the 310. That's a $5 wide call spread where I got $500 of risk. I collected $1.31 in premium. And just basically, yes, I am risking more to make less, but however, probability wise, it's a high probability trade. So, and currently I'm up on it. Still, long as the stock stays here, I'm good. I can hold it all the way to expiration all I want and then keep the $1.31 that I collected. But I won't. It's going to start decaying rapidly at this point, right around 23, 22, 21 days. The stocks, excuse me, the options will start to really depreciate and decrease in value. And so I'll be making a little bit more money faster on the decay of my options because I sold them. So I want them to decay. I didn't buy them. So long as it stays where it's at, or it can come up and just stay around in here. As long as it don't test me out here, then I'm fine. And so with that being said, guys, um, my whole analysis on the market right now, I wouldn't get long with somebody else's money. Like there's no, you couldn't give me money to get long with. I don't want to own any of this crap. And the right now the Fed, I've been listening to CNBC today, and think I was listening to Jeremy Siegel. I think it was last week when he was going off, and um, they tell you don't fight the Fed on the way up because the Federal Reserve, because we had 0% interest rates, everybody was getting stimulus checks, and the market was just rolling. Let's take a look at the S&P 500, the index. I mean, did nobody have a problem when the market was doing this? Let me see. This is a weekly. This is a 3-year weekly. I mean, everybody was yucking it up when the market was going up. Look at this. Each one of these candles, this is a weekly. This is coming off of the lows during COVID. And then this is when they just started giving out the stimulus. Look at the market. So, that everybody was saying don't fight the Fed on the way up. It just ran up. It literally doubled from the lows. The lows right around 2,200. This is 4,800 up here. Double. So now they're raising interest rates. They turned off the spigot. I don't think they're in the bond market doing any bond purchases right now. I don't think. I'm not sure, but I don't think they are. And so right now, we don't have the Fed on our side. So I expect equities to decrease. So this is the type of market where, you know how to do different strategies. Um, you can make a little money. You can preserve your capital, which to me, from what I was taught, that's what options are for. You have stocks, you may sell calls against your stocks. It's to preserve your capital, keep your money, don't lose your money. Like mainly using options, like you got this large stock portfolio, but you're using options to to um to preserve your capital so that you don't lose it all. Yeah, you just if you just own the stock go down, you're losing money, right? So you start looking at things like you start selling calls and maybe shorting futures and stuff like that hedge your risk, or not necessarily hedge your risk. I don't really like that term hedge. You either long or you're short, but just keep you from losing so much money. Let's put it like that. And so that's why I like trading options. I love it. I love trading, especially when I'm making some money. Um, they I still have fun even when I lose because I'm learning. So even when I lose money, I still enjoy it because I learn something and then I'll be like, I ain't gonna make that mistake again, right? So I was even looking at putting something on. I like to put stuff on when I have like a live video, but the thing is, I'm having a good day. You're having a good day. You be like, man, I'm just gonna back away and just let the stuff that's working work. Now I do think Tesla. We talk about Tesla and why I got short and why I'm gonna stay short. So basically, I got this bear flag right here. This is 4-hour chart. So on this big down move right here, got a fractal here. So you see this little triangle, pull back here. And then I put my Fibonacci's on, right? It came up, it hit that sweet spot, and then took out this low. That's a classic bear flag right there, right here. It's a bear flag. So you got that, then you got here, then you got your little zigzag here, and then it broke down here. Once I throw my fibs on, I want to see where I think it can get to. I honestly don't think Tesla's done falling. I see in its immediate future, I see about 252. 252 fib got like 251.62. So I just call it 252. So I think Tesla got some more to fall. Um, Definitely, if I were going to do this short spread today, this short call spread, I definitely wouldn't be out this far. I'm thinking about rolling these calls down. Eh. So rolling them down is like what is like moving it. So basically, the stock is down way down here, right? And I know it's up on the option chain. That's just how it looks. That's just how it is. You'll get used to it after a while. This is 305, and this is the stock price at 269 or currently. So I could roll this position down and pick up some credit. I could buy it here. So basically, to close it out, buy it back. This one I bought, so sell it, right? And then move it down. Let's say I came down let's say I rolled down to 290. Sell here, buy here. I could pick up $62 in credit. And that's what I was thinking about today. Like, should I do that? But technically, so that would put me like right here. And then I was just like, well, I could easily see this bucking and then moving up. And then, then it'll test me. Then I may have to roll out in time. So I think I'm gonna sit. I think I'm gonna sit and then see what happens once it gets here. I may close it out there and then look to put something else on. So I'll do a video again, do another video tomorrow because I want to see what the market does tonight after hours. And that's that, guys. My own personal opinion, we got more pain to come. We'll probably get a bounce because the market was so down today. So maybe overnight, I wouldn't be surprised if we open up tomorrow. I wouldn't be surprised if we open down tomorrow, but I wouldn't be surprised if we open up tomorrow, had a little bounce. Me personally, I definitely don't want to be long anything. I don't want to be long anything. You can't buy anything. Gold is flat, you know, but it's not going up. Well, all right, I take that back. Now, bingo, we got action. I had no idea what I'm going to do. We're getting ready to put a trade on live. And I'm going to show you what I see. First, I pulled up gold, the ETF. Now, this right here, this is a bull flag the other way. You see the up move, you see the pullback, and then we got this right here. For me, I'm getting ready to get in this. Now, the only thing about it now, do I want to sell a put spread or do I want to buy a call spread? Like, how do I want to trade it to make the most money? Now, if I go to gold, let's say we do this. Where is the most liquidity? Let's say we went 27 days. Ah, man. See, this is the only thing about it. I don't know if I want to, and I almost want to just buy a call option. Let's see. Oh man, I'm glad I looked at this. It's good look. I found something, guys. We got action. We got action. Gold. So based upon what I think gold getting ready to explode. Now I'm just trying to figure out right now what's the best way. Do I want to get in the futures market and trade the commodity, or do I want to trade the stock? Man, mm, I almost want to just buy. I almost just want to buy. I almost just want to buy a call right around 1700. I don't know how much that is though. How much is that? That's $3,200. I don't want to spend that. So I could buy this call spread right here and pay 250. Um, max profit 250, 250. Um, bet one, make one. Risk one, make one. 250 by 250. Um, how confident am I? Double this out. When you think you know something, though, that's what you. Some wise man told me, like, when you think you know something, that's where you mess up. So let's go look at it. Let's go look at GLD. If I decide to do, let's see. So I could, where would I put my short strike at, y'all? If I'm gonna do a $5 wide, sell the 153. But see, you don't get anything for it. Like they ain't really making no money. If I went $5 wide and sold this, like the basically I'm making like I'm risking 350 to make 145. I'd rather come over here. I'd rather do this. Where's the liquidity at though? 27 days. I'd rather come right here and do that. But that only give me 27 days to be right. I got 27 days, y'all, to hit this trade. It could explode. As you can see, I got a dilemma because let's look at the Australian dollar. Hey guys, if you watching this video, hit the like button, hit the subscribe button. I'm telling you, I'm going through stuff like live, and you're gonna see me. I'm getting ready to put a trade on. I'm just trying to figure out the best way to maximize my money, right? I want to see the reason why I'm looking at the Australian dollar is because the Australian dollar tends to move with gold. So if I would see a better setup here, I can trade the micro, kind of like AUD USD and Forex. I can trade that and just trade that tick for tick. Trading the gold, that's a large, it's pretty expensive. Trade. I'm gonna look at the micro gold futures. And I think it's like 50. So that would be because my stop would have to go here. And that would be, I don't know, that's like $1,000 stop loss. I don't know. I don't think I'm that confident. So this is what we're gonna do. We're gonna do this. We're gonna do this. I'm going to trade the gold futures. I think I'm gonna trade the 27-day. Come right here, sell the 1650. Buy that. I got an IV rank of 30. I can do that. I can do that. I want a high probability trade. That'll give me, I'm gonna move it out a little bit. Ooh. What can I get filled at one? I'm gonna sell the 35 Delta. I mean, I like this trade, guys. 1640. That means that's my short strike right there at 1640. All right, 35 Delta. Let's work this trade. Let's see if I can get filled. What time is it? I got 14 minutes. Let's try to get this filled, guys. Getting long gold. I'm selling a put spread to get long gold. I'm at 27 days. I don't want to keep going. When I'm at 170, as far as I'm going. 160 is it. I don't get filled here. Bing, 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 bing. There we go. So I like to put live trades on. Once again, This is a bullish trade. I'm selling a put spread to get long gold. I sold the 1640 and bought the 1635. I capped my, my risk, the most I can lose. I think I filled this trade for 160. It's a $5 wide trade. So that means I'm risking 340 to make 160. Now, the reason why I have a 64% probability of profit, so now the odds are on my side. I got the probabilities on my side. And you see right here in the Tesla trade that I still have open, I have a 76% probability of profit. So I got the math on my side. So even if my technical analysis is wrong, as long as I continue to put on these high probability trades like this, I should win more than I lose. Now, what I need to do is just manage what I lose. And therefore, that's my strategy. Now, with that being said, with gold in this setup, I will be looking to scalp in and out of gold, scalping the micro gold futures. Like I will be scalping this. I'll be up early this morning when the Euro session opens, probably around 1, 2 o'clock, looking to knock this out of the park. Trying to anyway. If I would have, I looked at the reason why you see me going back and forth between the futures and the gold ETF. I wasn't getting as much money on the gold ETF trying to trade it as I am with the futures. You see, I picked up 160 when I was messing around with it with the gold ETF. It was giving me like what, like 130 in premium, 140, 145. I ain't want to mess with the ETF. I was like, I just go to the futures market and we'll do it that way. And that's that, guys. So you got some bonus information. You got some live trading. If you follow me into this trade, you own it. Trade at your own risk. Don't take something I say or do as any type of financial advice. I like to do it. So I do it, built my channel around doing these type of trades and doing stuff like that. And I enjoy it. It was just fun for me. I like gambling. I like all of that, of course, responsibly, not no, I ain't saying I'm no big time gambler. I only have that type of money yet. And so I don't really, but the game is funner for me when I got, 10, $20 on it. I got doing a little fantasy football picks or something like that. Made me want to watch the game. Same thing with the market, you know. But anyway, guys, hit the like button, hit the subscribe button, share the video. I'm on here showing my real account, showing you gains, showing you losses when I lose, and making trades live. You get an opportunity to see, and this is the best platform in the world. Yeah, I got a link down in the description. You want to open an account with TastyWorks? Use my link, my affiliate link. Yes, I think I get like some little credits or something. It ain't nothing really big, but I get something. So help me out. If you got something out of this video, of course, that's my Cash App right there. If you want to Cash App me. You hit me with a couple dollars or something, $2, $3, $4, $5, maybe 10, whatever you feel like. Whatever God puts on your heart. Put it like that. Whatever he puts on your heart, you can put it in my pocket. With that, guys, I'm about to be out, man. Peace.